Hi and welcome to another video. So we're now just over 24 hours away from the budget, and it appears that this year it has more leaks than the latest iPhone release. However, that does at least allow us to get ahead and start to consider the pros and cons of all the proposals. So what are the implications of the budget looking like for property investors and buy-to-let business owners? There are three key areas we need to focus on, the first being corporation tax, then we have the stamp duty holiday extension, and finally the much talked about mortgage guarantee on 95% mortgages. If you are new to the channel, then do please like and subscribe, and let's dive into the details. So with regard to corporation tax, as a buy-to-let business owner, corporation tax is one of your biggest tax considerations. No one is quite sure at this stage whether we'll see an increase in corporation tax. A lot of people talking about it, maybe as much as a 5% increase. However, considering the fact that corporation tax was due to have been reduced to 17% by now, I personally feel the Chancellor needs to leave this well alone and leave just that little bit extra skin in the game for business owners at this time. However, the best thing any limited company business owner can do right now is to get all your affairs in line, and remember that you do only pay corporation tax on your profits. So ensure that you are on top of all your business expenses and maximising the tax efficient methods to extract profit from your business. Now, what for stamp duty and the extension to the stamp duty holiday? Well, pretty much an extension seems a done deal to the end of June, which is great news for all those thousands of people currently stuck in a stamp duty holiday backlog. Whether any brand new transactions will have time to complete before the end of June, that is questionable. However, it's certainly worth a try. Under normal circumstances, it certainly is possible to complete on the purchase of a property within 12 weeks. And anyone that's been holding out, thinking that they probably would miss out on the stamp duty holiday, and also considering that maybe property prices have peaked, you may want to reconsider. It really does feel like house prices are about to see another surge. So now for the biggie, the mortgage guarantee scheme. What is the mortgage guarantee scheme, you might ask? Well, it appears to be a slightly updated version of the original scheme introduced back in 2013 by the former Chancellor George Osborne. From what we know, so far this new version will be open to anyone, subject to the necessary affordability checks, of course. And this time around, it's not just for first-time buyers of new build properties. There is, however, an upper limit of £600,000. So it's certainly more generous than last time and probably more fair across the whole property market. As with the original scheme, the mortgage guarantee will all take place in the background. The mortgage provider will fund the full 95% of the mortgage, but the government will guarantee around 20%, therefore only exposing the banks to around 75%. With such favourable terms for the banks, this will certainly have the desired effect of encouraging them back into the high loan-to-value market, which throughout the last 12 months has virtually disappeared altogether. In the last 12 months, the number of deals with a 5% deposit went from 405 down to 5. However, since July 2020, as the housing market was booming due to the stamp duty holiday, the number of mortgage deals where only a 10% deposit was required did grow considerably from a low of 70 to 250 products. So this does beg the question, is the Chancellor actually being a little too generous and supporting a sector that seems to be recovering and doing okay on its own? Successive UK governments always attach so much importance on a growing housing market, which of course there is some strong arguments for. If house prices are growing, or at least not falling, then developers will continue to develop and build properties whilst they can see good strong profits. This does have many benefits for the wider economy, as there is a lot of direct and indirect employment reliant on a growing housing market. So if we focus specifically why the mortgage guarantee scheme is necessary, it all comes down to deposit affordability. As mortgage rates continue to be historically low, would-be homeowners find themselves in a very frustrating position. The monthly repayment on a mortgage has never been more affordable, yet as house prices soar in value, their ability to save for an ever-increasing deposit pushes homeownership further from their grasp. For example, in the last year alone, deposits have increased by 23%, which is slightly over £10,000. Now, obviously this has been fueled by the stamp duty holiday, which has pushed house prices up on average around 6%. So by tackling one problem, i.e. the stamp duty holiday, and encouraging growth in the housing market and stimulating it over the last year, the Chancellor's kind of created another problem for himself. As house prices have increased, deposits have increased. The problem with the scheme that encourages such a high loan to value ratio is that it diverts people's attention away from the real issue of affordable home ownership. People shouldn't be under any illusion that they don't own 95% of their home. If prices do go down, then there is very little margin before you find yourself in negative equity. Obviously, the dream is that prices go up and you ride that wave, and with every mortgage payment you make, you regain a little bit more equity. However, in the early years of any mortgage, the vast majority of your repayment goes towards the interest. You gain very little of the actual equity back for quite some time. What we're doing with a scheme like this is ingraining a mentality in people that very long-term debt is the norm, and as long as you can afford the monthly repayment, then you too can be a homeowner. However, normalising such high loan-to-value mortgages does financially disadvantage people throughout their lifetime. So does the Chancellor have a financial argument for the wider economy being built on a continued property market boom? It will certainly allow the economy to prosper as more households are created. More homes do need to be built so that first-time buyers can move out of mum and dad's. All of these new households will need to be furnished, and all of them will be paying their own set of household bills. Infrastructure is needed to support these expanding cities and towns, all of which stimulates the economy. Now, house prices grew faster during the pandemic than they have since 2014, which does beg the question, is any further stimulus really needed right now? The stamp duty holiday alone certainly had the desired effect of bolstering the housing market during what could have been a terrible time. And the extension to the stamp duty holiday beyond the 31st of March should in itself allow for some further stability in the market. The unfortunate consequence of a scheme such as the stamp duty holiday is that it has a short-term goal which creates hysteria and panic buying, which in turn has pushed house prices to new historical heights, which has increased how much homeowners need to save towards their deposits in the first place. And the knock-on effect of that has clearly led the Chancellor to believe that an additional scheme is required to address a self-inflicted problem. Yes, deposits for homeowners do absolutely need to be more achievable, but would the government not be more sensible in enabling individuals to be able to afford to save more towards the deposits in the first place? The problem with this strategy is that there's very little incentive for the government. In order for individuals to save more money, then they have to earn more money in the first place, which may require some tax cuts so that individuals have surplus income each month to put to one side towards this deposit. This mentality certainly doesn't help the government claw back some debt. If the government can get away with simply backing mortgages, then it may not actually cost them a great deal. For as long as interest rates remain low, then homeowners can afford their monthly repayment, and therefore not many should default on their mortgages. Making the most of these low interest rates right now should, generally speaking, keep the economy that little bit more buoyant, keep people in employment, and the cycle continues. Problems really occur when unforeseen circumstances come along and mortgage defaults start to increase, and suddenly this scheme is costing the government actual cash. Then the gamble hasn't paid off. So what are some real risks to the scheme? Boris Johnson said it himself during his Build Back Better speech in October last year. The housing market is broken, and there's a disgraceful situation where thousands of people still have the overwhelming desire to buy but simply can't afford to. Not because they can't afford the mortgage, but because they can't afford the deposit. Yes, Boris, this is true, but only for as long as people remain in employment and interest rates remain low. A word of warning on the risks of relying on historical low interest rates came from the chief economist for the Bank of England earlier this week. His words were that there may be an inflationary tiger on the loose, which could result in borrowing costs having to increase sooner than expected, and that we should not be complacent about interest rates having to rise to tackle the pressures of rising inflation. If inflation was to rise quicker than expected, then this would certainly catch out a lot of homeowners. Being able to secure a mortgage with a 5% deposit does sound wonderful, especially with house prices having risen to their highest levels ever. However, there are a few words of warning. Generally speaking, a mortgage with such a high loan to value does come with high interest rates. There is still also the issue of the loan to income ratio that is still capped at 4.5. Anyone wishing to purchase a property at the UK average of around £250,000 would have to be earning in excess of £50,000. Now, of course, this may not be an issue for households with more than one income. Anyway, the combination of the stamp duty holiday extension and now the mortgage guarantee scheme, I do believe we are about to see a further surge in house prices. As property investors, it's possibly a great opportunity to flip some unloved properties. For example, me personally, I do have a 1920s traditional semi-detached property with a very long-standing tenant, probably been with me around 15 years now at least. They have quite literally made the house their home. Have spent quite a bit of their own money on the property, and because I've had to spend very little of my own money on the house, I have therefore kept the rent at a very reasonable level for them. They always had the intention of wanting to buy the house from me, but were never really in a position to do so. So therefore, with the introduction of this new mortgage guarantee scheme and the ability to acquire a mortgage with a 5% deposit, the opportunity could now be available to them. The benefit being that they get to own the property that they've already made their home, and I get to extract capital which I can then reinvest for a better monthly return. Anyway, lots to think about with this budget and quite possibly some good opportunities ahead of us. Thank you for watching. Do please like and subscribe, and I'll be back again soon with another video. Thank you.